Gold prices slipped from $1,800, but China and India demand supports as QE drives up copper. Gold prices fell but were seen resuming their longer-term uptrend by traders on Thursday, slipping $10 per ounce from yesterday's 8-week peak near $1,800 as Western government borrowing cost rallied following, no change, to the European Central Bank's historic easy money policies. India posted a fresh daily record for both new COVID cases and deaths at 300,000 and 2,100 respectively. The European Union meantime said it won't take up an option to increase its purchases of the Oxford-AstraZeneca vaccine by 1/3. For the UK, where 1 in 5 adults has now received 2 shots of vaccine, March was the first month since October that COVID-19 was not recorded as the #1 cause of death. Back in Frankfurt, the ECB today led its April press release by saying it decided to reconfirm its very accommodative monetary policy stance. Deposit rates for commercial Eurozone banks have now been below zero since mid-2014. Money creation for buying financial assets has now taken the 19-nation central bank's balance sheet above $9 trillion, over 3 times its size a decade ago. After a pause to refresh, the copper price is rising again, says French bank and London bullion market maker Société Générale's global strategist Albert Edwards. Most think this is a sign of the strength in the economic cycle. But the surge in agricultural prices, just as in 2011 that triggered the Arab Spring revolutions, suggests this is more to do with QE again. With today's climate summit hosted by US President Biden expected to signal massive, green infrastructure spending to try meeting newly aggressive greenhouse gas emissions targets, base metal copper today rose back towards start March's 10-year highs, edging within 8% of early 2011's record peak. Silver in contrast, and despite being key to many green technologies led by PV solar panels, retreated with gold, down 30 cents per ounce after ticking its highest since start March at $26.64 on Wednesday. Gold priced in euros erased the week's earlier 1.0% gain, dropping €15 per ounce to €1,481 after touching 9-week highs near €1,500 yesterday ahead of the ECB's latest policy decision. Indian and Chinese consumers have rediscovered their appetite for gold, says Bloomberg, reporting the latest export data from global gold refining hub Switzerland. While reaching barely 9 tons in March, Swiss exports to #1 consumer nation China were the highest in 7 months, with sources telling the Newswire that the People's Bank has now granted import licenses for total inflows of 75 tons per month from now on. #2 India meantime took in nearly 83 tons of Swiss gold bullion bars last month, the most since the precious metals historic price crash of April 2013. Gold should remain supported by continued physical interest out of both Shanghai and India, while gold ETFs are beginning to see recent outflows dry up, says a trading note from Swiss refining and finance group MKS PAMP. Recent short builds, in speculative bearish bets on gold futures and options, are holding for the time being. However, we expect these to be tested through $1,800 to drive price action higher. Further down the line, says a note from the precious metals team at French bank and London bullion market maker BNP Paribas, the fundamental backdrop is more constructive than at any time this year. $1,830 could become a pivot, BNP says, pointing to what it calls a congestion zone from Jan-Feb's price action, where industrial, physical buying and other broader investment money flows would materialize on any temporary price pullback. Meantime, in so-called digital assets, most cryptocurrencies fell again, with joke crypto Dogecoin almost halving from last week's new peak after Turkey's clampdown on the sector saw the police launch an investigation into a failed trading exchange whose CEO appears to have fled owing a notional $2 billion in assets to 390,000 users. UK banking giant NatWest today said it will now refuse business clients whose main business is accepting or trading crypto owing to the high risk